Investing is one of the best decisions you can make when it comes to building your wealth and planning for your financial future. The benefits of smart investing are plenty, and when done wisely, investing can allow you to outpace rising inflation and build wealth on your terms. The benefits of investing can be profound. That's why today I'll tell you about the 10 best long and short-term investments for 2023. I'm going to tell you about the investment options that take rising inflation and interest rates into account, providing options for both high and low-risk investors. I also have a bonus tip for you at the end, so stay tuned. Without further ado, let's get started. 1. Value stocks. Number 1 is value stocks. Value stocks are stocks that are traded at a relatively low price, as investors sometimes view them as undesirable, which drives their price down. But if you're patient, value stocks can make you significant profit down the road, since you can buy them at a bargain price. They are best for higher risk investors who are willing to commit to a long-term investment. Value stocks are more affordable than most growth stocks and perform better than growth stocks when interest rates rise. You can buy value stocks from online brokers. 2. Cryptocurrency. Next is cryptocurrency. It has been one of the hottest investments of the last few years, mainly because of the price volatility. Coin prices fluctuate dramatically because they're influenced by supply and demand, as well as media attention. That's why investing in crypto has become popular, because of its high risks and potentially large payoff from relatively small investments. Crypto is popular with investors with the highest risk tolerance, as you can score big on crypto, but the price of the coin can plummet quickly. Crypto is easily accessible, and you can buy it from traditional brokers as well as online crypto exchanges. 3. Small cap stocks. Small cap stocks are shares of a public company that are valued at around $500 million to $1 billion. By investing in small cap stocks, you are betting on the future success of the company. Small cap stocks are best for higher risk investors who don't mind holding the investment for a long time, as investing in small cap stocks means you're investing in younger companies. But small cap investments have the potential for greater growth than large cap stocks. You can buy small cap stocks from the majority of online brokers. 4. Corporate bonds. Next are corporate bonds. They are typically issued by successful companies and often yield high dividends. In 2022, corporate bond yields were near multi-year highs and less risky than stocks. You're betting on a successful company to continue being successful when you invest in a corporate bond. Corporate bonds can be a good option for medium risk investors looking for a less volatile investment option than stocks. You can buy bonds through major brokers like Charles Schwab. 5. Dividend stock funds. Next are dividend stock funds, which are mutual funds or exchange-traded funds that invest in stocks that pay dividends. Dividend stock funds allow you to diversify your investments, so you're not relying on one company. You anticipate that the companies within the fund will continue to profit over time, and if you choose carefully, you may get payouts quarterly. They are appealing because investors can profit through increases in the share price, as well as dividends paid by the company. If the company is generating profits, you receive cash regularly, and if you invest in a company that continues to profit, you'll profit as well. You can buy dividend stock funds through brokerage firms. Before I tell you about the next investment method, make sure you hit the like button and subscribe to my channel for amazing financial content. 6. Growth stocks. On number 6 in this list are growth stocks. Growth stocks are shares in companies that grow at a higher rate than average market growth. Growth stocks are typically issued by companies that churn their profits back into their business and don't pay out dividends, a popular investing strategy in bear markets. They are attractive because you tend to make money through capital gains, meaning you could sell the stock further down the road for more than you paid for it. Growth stocks are more suitable for market-savvy investors who have a solid understanding of market trends with higher risk tolerance. You have to choose the right growth stocks, which requires knowing which companies are best positioned to profit from the current market. If you hold on to your growth stock long enough, you could possibly get a big payout when you eventually sell. You can buy growth stocks through any online stockbroker like Robinhood. 7. Real estate or real estate investment trusts, REITs. Now, investing in real estate is a long-term investment, and it requires a larger amount of capital upfront. But real estate is also one of the most attractive investments because of the potential for high returns. It doesn't take an inordinate amount of wealth to invest in real estate. And if you want to invest in real estate, you can take out a loan from your bank and pay it off over time. Real estate investment trusts are a way to buy real estate without having to own or manage the property, as REITs are companies that own commercial real estate and provide large dividends. This makes them a good investment if you're not interested in investing in properties yourself. Real estate can be best for you if you are committed to a long-term investment and have the time to manage property. But if you don't want to manage it yourself, then investing in REITs is for you. Also, if you go for REITs, there may be more opportunities to diversify your investments. You can buy shares in REITs through brokerage firms. 8. S&P 500 Index Fund. Next is S&P 500 Index Fund. Investing in these funds means you're investing in the 500 largest companies by market capitalization. By investing in the S&P 500 Index, you're automatically diversifying your portfolio since you're putting a stake in 500 different companies. Investing in S&P 500 is great for beginners willing to hold onto a long-term investment. It doesn't require a ton of market savviness as you're investing in large, successful companies. You can invest in the S&P 500 index funds through any stockbroker. 9. High-yield savings accounts. On number 9 are high-yield savings accounts. They differ from traditional savings accounts because they pay out a much higher APY, which is annual percentage yield. Because high-yield savings accounts have a higher interest rate, the payout is generally higher as well. Investors also get the stability of a federally insured account. High-yield savings accounts can be best for you if you're looking for quick wins on small investments, because these accounts tend to have a low minimum deposit or no minimum at all. High-yield savings accounts are FDIC insured, so deposits up to $250,000 are protected in the event of bank failure. Traditional banks with multiple branches and online banks offer high-yield savings accounts. 10. Money market mutual funds. Lastly, we have money market mutual funds. Being one of the lowest risk investments, these are fixed income mutual funds that invest in debt securities with little to no credit risk. They are generally safer because the debt securities they hold are required to follow regulatory requirements, meaning they have to reach a certain standard of quality, liquidity, and maturity. Money market mutual funds lend themselves to low-risk investors looking for quick cash, while the compensation isn't as high as other investments, and risk and volatility are much lower. But keep in mind that money market funds aren't government issued. So if your bank goes bankrupt, you'll likely lose your investment. But because of low volatility and little risk, you're very likely to see positive yields. You can invest in money market mutual funds through mutual fund firms and brokerage companies. Now on to the bonus tip that I have for you. What you should consider before investing. It depends on a variety of factors, like your budget, risk tolerance, and financial knowledge. Your budget will dictate what investments you can make. For example, investing in real estate isn't realistic for beginner investors, but a lower budget investment can be a value stock. Now, risk tolerance refers to how willing you are to risk market volatility. High-risk investors may see more returns than low-risk investors, but the potential for loss is also greater. You also need to consider your financial knowledge when investing. For example, investing in growth stocks requires a detailed understanding of market trends and what companies can thrive in the current market, while the S&P 500, on the other hand, will do that part for you, and it doesn't take significant financial knowledge to know that it'd be relatively safe to invest in them. Just weigh your goals, budget, risk tolerance, and how long you're willing to wait on returns and go for it. So that's all for today, guys. Make sure you give this video a thumbs up and subscribe to my channel so you don't miss out on the fantastic financial content. Until next time.